Chapter 2. The Basics. The transition from theory to practice was exhilarating for Juju. Armed with his trading plan and the knowledge imparted by James, he felt a newfound sense of confidence. However, he soon realized that the real test lay in consistently applying these principles in the fast-paced world of Forex trading. In their next meeting, James decided to focus on reinforcing the basics. Before we move on to more advanced strategies, it's crucial to have a solid grasp of the fundamentals, he explained. Juju nodded eagerly. I'm ready to dive deeper. James began by revisiting the core concepts of support and resistance. He explained that these levels are not just lines on a chart, but represent psychological barriers where the collective actions of traders influence price movements. Support is like a safety net, James said, sketching a simple diagram. It's where buyers tend to step in and prevent the price from falling further. Resistance is the opposite. It's where sellers emerge and stop the price from rising. Juju followed along, making detailed notes. So, these levels are formed by past price action? Exactly, James affirmed. They're based on historical price movements. Traders remember these levels, and their actions reinforce them. They spent the next few hours analyzing various charts, identifying support and resistance levels, and discussing how these levels could be used to make trading decisions. James emphasized the importance of context, explaining that the strength of a support or resistance level depends on the number of times it has been tested and held. Look at this chart, James said, pointing to a currency pair. This support level has been tested multiple times over the past few months. Each time, the price bounced back up, indicating strong buying interest. But remember, no level is invincible. Market conditions can change, and what was once a strong support can eventually break down. They also discussed the concept of false breakouts, where the price appears to break a support or resistance level, but then quickly reverses. These false breakouts can trap traders, James warned. It's important to wait for confirmation before taking a trade. Juju found this session particularly enlightening. The detailed analysis and practical examples helped him understand the nuances of support and resistance levels, and how they could be used to make informed trading decisions. As their sessions continued, Juju and James delved deeper into the practical application of support and resistance levels. One day, James introduced the concept of trend lines, and how they could be used to enhance the analysis. Trend lines are dynamic support and resistance levels, James explained. They're drawn by connecting the highs or lows of a price chart. They help us identify the overall direction of the market. Juju was intrigued. So, trend lines can show us the trend of the market? Yes, James confirmed. An upward trend line is drawn by connecting the higher lows, indicating an uptrend. Conversely, a downward trend line connects the lower highs, indicating a downtrend. They practiced drawing trend lines on various charts, discussing how these lines could provide additional insights into market behavior. James emphasized the importance of combining trend lines with horizontal support and resistance levels to create a more comprehensive analysis. Look at this chart, James said, pointing to an example. We have a clear uptrend here, but notice how the price also respects this horizontal support level. Combining these two elements gives us a stronger indication of where the price might go next. Juju found this approach incredibly useful. He realized that by combining different tools and techniques, he could gain a deeper understanding of market dynamics and make more informed trading decisions. They also discussed the concept of confluence, where multiple indicators or levels align to provide a stronger signal. Confluence is powerful, James said. When you have multiple factors indicating the same outcome, it increases the probability of a successful trade. Juju practiced identifying areas of confluence on his charts, noting how different elements could come together to provide stronger signals. He appreciated the holistic approach that James advocated, combining technical analysis with market psychology. With each session, Juju's confidence grew. He felt more equipped to tackle the markets and navigate the complexities of trading. James decided it was time to introduce another crucial aspect of trading: risk management. Risk management is essential for long-term success, James began. Even the best strategies can fail if you don't manage your risk properly. Juju nodded, understanding the importance of this lesson. How do I ensure I'm managing my risk effectively? James outlined several key principles of risk management. First, never risk more than a small percentage of your trading capital on any single trade. This way, even if you experience a string of losses, you won't wipe out your account. They discussed the concept of position sizing and how to calculate the appropriate amount to risk on each trade. James showed Juju how to use tools like the risk-reward ratio to determine whether a trade was worth taking. Always aim for a risk-reward ratio of at least 1 to 2, James advised. This means you're aiming to make at least twice as much as you're risking. It helps ensure that even if you have more losing trades than winning ones, you can still be profitable. They practiced calculating position sizes and setting stop-loss and take-profit levels based on the support and resistance strategy. James emphasized the importance of sticking to these levels and not moving them based on emotions. Your stop-loss is there to protect you, James said firmly. Once you've set it, don't move it. Accept the loss and move on to the next opportunity. Juju found this advice invaluable. He realized that risk management was not just about protecting his capital, but also about maintaining a disciplined and consistent approach to trading. As Juju applied the principles of risk management to his trading, he noticed a significant improvement in his results. He felt more confident and in control, knowing that he had a plan to protect his capital and maximize his profits. During one of their sessions, James decided to introduce Juju to the concept of trading psychology. Understanding your own psychology is crucial, James said. Your mindset can greatly influence your trading decisions. Juju was intrigued. How do I develop the right mindset for trading? James explained that successful trading requires a balance of confidence and humility. You need to be confident in your strategy, but also humble enough to accept that you will make mistakes. It's important to learn from those mistakes and not let them affect your future decisions. They discussed common psychological pitfalls, such as overtrading, revenge trading, and fear of missing out, FOMO. James shared stories from his own experiences, highlighting the emotional challenges he had faced and how he overcame them. Overtrading happens when you feel the need to be in the market all the time, James said. It's driven by the fear of missing out on opportunities. But remember, sometimes the best trade is no trade at all. Juju nodded, taking notes. How do I avoid these pitfalls? James offered several practical tips. First, stick to your trading plan. It's your roadmap and will help you stay disciplined. Second, keep a trading journal. Document your trades and the emotions you felt. Reflecting on this will help you identify patterns in your behavior. They also discussed the importance of taking breaks and maintaining a healthy work-life balance. Trading can be intense, James said. It's important to take breaks and recharge. A clear mind will make better decisions. Juju appreciated this holistic approach to trading. He realized that success in trading was not just about technical skills but also about understanding and managing his own psychology. As Juju continued to grow as a trader, he found himself developing a deeper appreciation for the nuances of the market. James's mentorship had provided him with a solid foundation, and he felt more prepared than ever to tackle the challenges ahead. One evening, as they were wrapping up a session, James shared a piece of wisdom that resonated deeply with Juju. The market is like a mirror, James said. It reflects your own strengths and weaknesses. The better you understand yourself, the better you will understand the market. Juju pondered these words, realizing that trading was not just a profession, but a journey of self-discovery. He felt grateful for James's guidance and the invaluable lessons he had learned. With renewed determination, Juju continued to practice and refine his skills. Juju's daily routine now included dedicated time for analyzing charts, reviewing trades, and reflecting on his trading journal. Each entry in his journal was a step forward, a learning opportunity that brought him closer to mastering the craft of trading. During one of their sessions, James decided to introduce Juju to the concept of multiple timeframe analysis. Analyzing different timeframes can give you a broader perspective on the market, James explained. Juju was intrigued. How does that work? James opened a chart and showed how the same currency pair could look very different on different timeframes. For instance, a support level on a daily chart might be just a small fluctuation on an hourly chart. By looking at multiple time frames, you can get a better sense of the overall trend and avoid getting caught up in the noise. They practiced this approach, analyzing the same currency pairs on weekly, daily, and hourly charts. James explained how to identify major trends on higher time frames and use lower time frames for precise entries and exits. This technique helps you align your trades with the bigger picture, James said. It reduces the risk of getting whipsawed by short-term volatility. Juju found this concept extremely useful. He realized that combining multiple time frames could help him make more informed and confident trading decisions. He practiced identifying trends and support and resistance levels across different time frames, noting how they influenced each other. As Juju's understanding of the markets deepened, James decided it was time to introduce him to the concept of price action trading. Price action trading focuses on the movement of price itself without relying on indicators, James explained. Juju was curious. How do we do that? James began by explaining the basics of candlestick patterns. Candlesticks provide a lot of information about market sentiment. Patterns like doji, engulfing, and hammer can give us clues about potential reversals or continuations. They spent the session reviewing various candlestick patterns and what they signaled about market behavior. James emphasized the importance of context, explaining that the same pattern could have different implications depending on where it appeared in the trend. For example, James said, pointing to a chart, a hammer candlestick at a support level might indicate a strong buying interest and a potential reversal. But the same pattern in the middle of a trend might not be as significant. They practiced identifying these patterns in historical charts, discussing their potential implications and how they could be used to inform trading decisions. Juju found this approach enlightening. He appreciated the simplicity and clarity of price action trading. As they continued to explore price action trading, James introduced Juju to the concept of market structure. Understanding market structure helps you see the bigger picture and make sense of price movements, James explained. Juju listened attentively. How do we identify market structure? James began by explaining the concepts of higher highs and higher lows in an uptrend, and lower highs and lower lows in a downtrend. These patterns help us identify the overall trend and potential reversal points. They practiced identifying market structures on various charts, noting how trends developed and changed over time. James emphasized the importance of being patient and waiting for clear signals before making a trade. Rushing into trades can lead to mistakes, James warned. Always wait for confirmation of the trend or reversal. Juju practiced this approach, learning to read the market structure and use it to inform his trading decisions. He realized that understanding market structure gave him a clearer picture of the market and helped him make more informed trades. With each passing session, Juju's confidence grew. He felt more equipped to tackle the complexities of Forex trading and navigate the ups and downs of the market. James's mentorship had provided him with a solid foundation, and he was eager to continue learning and improving.